Hi everyone, welcome back to the channel. If you're new here, make sure to hit the subscribe button and turn on notifications for more personal finance tips. In today's videos, we're going to talk about something that many people wonder about: how to invest for retirement with just $50 a month. It may seem like a small amount, but I'm going to show you just how that modest investment can add up over time with the power of compound interest and smart choices. So, if you've been putting off saving for retirement because you think you need a big paycheck to start, keep watching. First off, let's talk about compound interest. This is one of the most powerful tools in investing. Simply put, compound interest means that the money you make from your investments earns interest, and that interest itself earns interest. It's like a snowball rolling down a hill and getting bigger and bigger as time goes on. Now, let's use an example. Imagine you're putting in just $50 per month into an investment. Over time, that money doesn't just sit there, it grows. So, even though $50 may not seem like a lot right now, you're setting yourself up for long term growth. If you were to contribute $50 a month for 40 years at an average return of 7% annually, you'd end up with about $80,000. And that's just from small contributions. Now, I'm sure you're wondering, well, what's the catch here? Well, it's not an overnight thing. The key to this whole process is time. The earlier you start, the more your money can grow. And that's why it's so important to start investing, even if it's just $50 per month, as soon as possible, because time is your friend when it comes to building wealth. Now that you know how powerful $50 can be, let's talk about where to invest that money. When you're working with a small amount, you want to make sure you're choosing investments that are cost effective and diversified. Let's look at some options that are ideal for low cost, long term investing. Index funds and ETFs. The first option I highly recommend is index funds or ETFs, exchange traded funds. These are types of funds that invest in a broad group of stocks and bonds, which helps to spread out risk. Instead of buying individual stocks, an index fund or ETF automatically gives you exposure to dozens or even hundreds of companies. The beauty of index funds is that they have very low fees and they track the performance of the market index like the S&P 500, which historically has provided an average annual return of around 7% over the longer term. This is great because you're not paying for a fund manager to actively pick stocks. The fund just mirrors the market, which is both simple and very effective. Number two, robo-advisors. Another great option, especially for beginners, is a robo-advisor. These are automated platforms that create and manage your investment portfolio for you. You answer a few questions about your risk tolerance and goals, and the robo-advisor builds a portfolio of ETFs for you, managing it over time. Some popular robo-advisors include Betterment and Wealthfront. And the best part is that they have low fees and allow you to start investing with just a small amount, often as little as $5. These are perfect if you don't have a lot of time to manage your investments, but still want to see your money grow. Number three, high yield savings accounts or CDs. If you're looking for a super low risk option while you build your initial investment, consider a high yield savings account or a certificate of deposit. These won't offer the same growth as stocks or bonds, but they're a safe place to park your money while you build up to more aggressive investments. A high yield savings account can offer around 3 to 4% interest, which is much higher than the typical savings account. It's a really good place to park your emergency fund or to build up savings before making other investments. One of the easiest ways to make sure you're consistently investing every month is to automate your contributions. When you automate your investments, you remove the temptation to skip a month or forget to invest. Plus, it makes it easy to stay consistent over the long term. Most investment platforms, whether it's Vanguard, Fidelity, or Acorns, allow you to set up recurring monthly contributions. You can start with as little as $50 per month and then increase your contribution as your income grows. But the key here is definitely consistency. Automation also helps you take advantage of something called dollar cost averaging. This means that you're investing a fixed amount regularly, regardless of the market's ups and downs. Over time, this can help reduce the impact of market volatility as you'll be buying investments at different prices. Finally, the most important thing you need when investing for retirement is patience. Investing is a long term game, so don't expect to see huge returns overnight. But if you stay consistent, stick with your strategy, and let your money grow over time, you'll be amazed at how much you can accumulate with just $50 per month. So, to sum it all up, yes, you can invest for retirement with just $50 a month. It may seem small, but with compound interest, the right investments, and consistent contributions, you can build a solid retirement fund over time. Start small, be patient, and watch your money grow. Thanks again for watching, and don't forget to hit the like, subscribe, and drop a comment below if you have any questions or tips of your own. I'll see you in the next video.